While most investors are celebrating recent gains, a handful of strategists are quietly repositioning for something far larger. The charts show a breakout, but the real story isn't being told in price movements. It's hidden in central bank vaults, in geopolitical backrooms, and in supply chains that haven't been this fragile in decades. Three forces are converging. Forces that historically appear only once every generation. The question isn't whether precious metals will move higher. The question is whether you'll recognize what's actually happening. Before the window closes, what comes next will separate the prepared from the blindsided. Welcome to the channel. This is John A.G. If you've been following markets long enough to remember when information wasn't instant, when decisions required actual research, then you understand the value of thoughtful analysis over noise. I'd ask you a favor, the kind neighbors use to ask each other, if this type of breakdown serves you well, if it helps you think more clearly about where to position your capital, would you consider subscribing? Not because of algorithms or trends, but because good analysis deserves an audience that values it. And while you're here, drop a comment and tell me where you're watching from. I'm genuinely curious whether this message is reaching someone in Singapore at dawn, or someone in Texas over morning coffee, or perhaps someone in London during lunch. Geography shapes perspective. I'd like to know yours. Now, let's get into what's actually happening. Something fundamental shifted in global markets during the final months of 2024. It wasn't loud. It wasn't announced in press conferences, but those who watch capital flows noticed immediately. Gold crossed levels it had never seen before. Silver broke through psychological barriers that had held for years. And suddenly, the conversation changed. Not among retail traders chasing headlines, but among the institutions that move billions without making noise. The analysts at major banks began rewriting their 5-year forecasts. Sovereign wealth funds quietly increased their physical allocations. And mining executives who had spent a decade managing declining expectations suddenly found themselves fielding calls from investors who had not shown interest in years. This wasn't speculation. This was repositioning. When professionals with decades of experience start changing their models simultaneously, it signals something deeper than a typical market cycle. It signals structural change. The perfect storm metaphor gets overused in financial media. But in this case, it fits with uncomfortable precision. Because what's happening in precious metals right now isn't driven by one factor. It's the convergence of three separate forces, each powerful on its own, but together creating conditions that haven't existed since the 1970s. The first force is monetary. Central banks around the world spent the last 15 years experimenting with policies that previous generations of economists would have called impossible. Zero interest rates. Negative interest rates in some regions. Trillion-dollar balance sheet expansions. They did this to fight deflation, to support growth, to manage debt burdens that had grown too large to service conventionally. And for years it seemed to work. Markets climbed. Economies expanded. And critics who warned about currency debasement looked foolish. But policies have consequences. And those consequences don't always arrive on schedule. Now, central banks face an impossible choice. They can maintain loose monetary conditions and watch inflation erode purchasing power. Or they can tighten policy and risk triggering the debt crisis they've been postponing for over a decade. Either path leads to the same conclusion for investors holding paper currency: devaluation. Not the dramatic overnight collapse that makes headlines, but the slow, grinding loss of value that transfers wealth from savers to debtors, from the prudent to the protected. Gold and silver don't care about central bank announcements. They respond to what central banks actually do. And what they are doing now is creating conditions where hard assets become the only rational store of value. The second force is geopolitical. The post-World War II global order operated on certain assumptions: that trade would remain relatively free, that the dollar would function as the world's reserve currency, that international disputes would be managed through institutions rather than direct confrontation. Those assumptions are breaking down. Nations that once accepted dollar dominance are now actively building alternatives. Trade relationships that seemed permanent are being renegotiated, and conflicts that were supposed to be impossible in an interconnected world are happening anyway. When trust in the global system declines, when nations start questioning whether their reserves are truly safe, they don't turn to new digital currencies or experimental financial instruments. They turn to what has preserved wealth for thousands of years. Physical gold held in domestic vaults, silver stored where it can't be frozen by foreign governments, assets that exist outside the system, beyond the reach of sanctions, immune to counterparty risk. Central banks in Asia, the Middle East, and even parts of Europe have been accumulating gold at rates not seen in decades. Not because they expect the system to collapse tomorrow, but because they're preparing for a world where the old arrangements no longer guarantee security. The third force is structural. Silver, unlike gold, isn't just a monetary metal. It's an industrial commodity essential to the technologies defining the next decade. Solar panels require it, electric vehicles need it, Electronics can't function without it, and the supply isn't keeping pace with demand. Mining output has plateaued, new discoveries are rare, and the existing above-ground inventory is being drawn down faster than it's being replenished. This creates a unique situation, where monetary demand and industrial demand are competing for the same limited resource. In previous bull markets, silver moved because of speculation. This time, it's moving because the world actually needs it, and there isn't enough to go around. These three forces, monetary instability, geopolitical fragmentation, and structural supply constraints, don't just add to each other. They multiply, each one amplifies the others, creating conditions where small moves in fundamentals produce large moves in price, and the professionals who understand market history recognize what that means. The early stage of a generational repricing has already begun. In September 2023, a little-noticed event occurred in the London precious metals market. A major bullion dealer requested physical delivery on a silver contract, and the settlement took 3 weeks longer than normal. No headlines, no panic. Just a quiet delay that told professionals everything they needed to know. The paper market and the physical market were starting to drift apart. Most investors never think about this distinction. They see a price on their screen and assume that's reality. But there are actually two silver markets operating simultaneously. One where contracts trade electronically in milliseconds, and one where actual metal moves from vaults to trucks to warehouses. When those two markets price things differently, when getting physical delivery becomes difficult, it means the system is under stress, and stress in commodity markets doesn't resolve peacefully. It resolves through price. The mechanics driving the separation aren't complicated, but they're invisible to anyone who only watches charts. Start with what central banks are actually doing, not what they say they're doing. The Federal Reserve talks about data dependency and gradual policy adjustments, but the money supply numbers tell a different story. After the fastest tightening cycle in 40 years, liquidity conditions are shifting again. Not because inflation is defeated, but because the alternative, a wave of defaults across over-leveraged sectors, is politically unacceptable. When liquidity expands, it doesn't flow evenly into all assets. It flows first into whatever has been most suppressed, whatever offers the best risk-reward for professional capital. And right now, that's precious metals. Hedge funds that wouldn't touch gold 2 years ago are building positions. Family offices that dismissed silver as too volatile are allocating 5 or 10% of portfolios. Even traditional pension funds, institutions famous for moving slowly, are quietly increasing their commodity exposure. This isn't retail enthusiasm. This is institutional repositioning ahead of what they see coming. But monetary policy alone doesn't explain the intensity of the current move. The geopolitical component is accelerating faster than most analysts anticipated. Consider what happened in the first quarter of 2024. China's central bank added more gold to its reserves in 3 months than it had acknowledged acquiring in the previous 3 years. Russia continued buying despite sanctions. India's imports hit record levels. And central banks collectively purchased more physical gold than at any point since 1967. That's not diversification. That's preparation. These institutions don't make decisions based on quarterly performance. They operate on decade-long time horizons. And when they move in the same direction simultaneously, it signals a fundamental reassessment of systemic risk. The dollar's role as the global reserve currency isn't ending overnight, but its monopoly is fracturing. Trade settlements in yuan, rupees, and even gold-backed instruments are increasing, not because countries hate the dollar, but because recent events demonstrated that reserve assets can be weaponized, frozen, or seized for political reasons. That changes the calculus entirely. If your reserves can be locked out of the system during a dispute, then holding them in the system becomes a strategic vulnerability. Physical gold stored domestically solves that problem, which is why central banks are willing to pay premiums to secure it. Now layer in the supply side, and the picture becomes even tighter. Silver production peaked in 2016. Since then, output from major mines has declined, while demand from industrial applications has surged. The solar industry alone is projected to consume more silver in the next 5 years than currently exists in available inventory. Electric vehicle production requires specialized silver components. 5G infrastructure build-out needs it. Advanced electronics can't substitute cheaper metals without performance degradation. This isn't speculative demand that disappears when prices rise. This is structural demand that persists because the alternatives don't work. And here's where the mechanics become dangerous for those positioned incorrectly. The futures market, where most price discovery happens, operates with leverage ratios that assume physical delivery will rarely be requested. For every ounce of physical silver, there are hundreds of ounces of paper claims. That works fine when participants are content to settle in cash. But when industrial users start demanding actual metal, when central banks insist on physical delivery, the whole structure becomes unstable. We've seen this movie before, in palladium during the early 2000s, in rhodium in 2008, in lithium more recently. Markets where paper abundance met physical scarcity. And prices didn't adjust gradually, they adjusted violently. The professionals watching these mechanics aren't asking whether precious metals will move higher. They're asking how quickly the adjustment happens, and whether their positioning allows them to benefit rather than getting caught on the wrong side. Because the gap between what contracts promise and what vaults can deliver isn't closing, it's widening. In a private meeting room in Zurich during late 2024, a family office manager presented an unusual proposal to his clients. He recommended they reduce their exposure to corporate bonds, liquidate a portion of their tech stock holdings, and allocate 15% of the portfolio to physical precious metals and mining equities. The clients, third-generation wealth holders who had never owned an ounce of gold, asked the obvious question, why now? His answer wasn't about price predictions or technical charts. It was about what happens when the assumptions underlying an entire financial system start to crack. And whether they wanted to be positioned before that became obvious to everyone else, or after. This conversation is happening in wealth management offices across the world right now. Not in retail brokerage accounts, not on social media trading forums, but in the rooms where serious capital makes quiet decisions. Because institutional investors operate differently than individuals, they don't chase trends, they position ahead of them. The sovereign wealth funds moving into precious metals aren't doing it because gold hit a new high. They started accumulating 2 years ago when prices were boring and nobody was paying attention. The pension funds adjusting their commodity allocations now aren't reacting to recent moves. They're implementing strategic shifts that were approved in committee meetings months earlier. By the time retail investors notice something happening, by the time financial media starts running excited coverage, the smart money has already established its positions. That's not insider trading. That's the structural advantage of thinking in years instead of weeks. So where does that leave someone trying to position intelligently right now? The first question isn't, should I buy? It's, what am I actually buying and why? Because precious metals aren't a single asset class. They're a spectrum of risk and return profiles that behave very differently under stress. Physical gold offers wealth preservation. It doesn't produce income. It doesn't grow, but it maintains purchasing power when paper currencies don't. Physical silver offers the same monetary protection, but with industrial leverage that can amplify moves in both directions. Mining equities offer operational exposure to rising metal prices, with the complexity of management quality, jurisdiction risk, and operational execution. Junior exploration companies offer asymmetric upside, with the understanding that most will fail, and portfolio construction must account for that reality. Royalty and streaming companies offer leveraged exposure without operational risk, but they trade at valuations that assume the bull market continues. Each of these serves a different strategic purpose, and serious investors don't pick one. They blend them according to their specific risk tolerance and time horizon. A retiree protecting purchasing power might hold 70% physical, 20% royalty companies, 10% senior miners. An aggressive wealth builder might flip that. 20% physical is insurance, 30% senior producers, 50% carefully selected juniors with discovery potential. There's no universal answer, but there is a universal mistake. Confusing allocation strategy with market timing. The professionals getting this right aren't trying to predict the exact top or bottom. They're building positions in tranches, spreading entry points across months, managing risk through position sizing rather than perfect timing. Because the real risk isn't buying too early. It's waiting for certainty that never comes, and watching the opportunity pass while still gathering information. Now consider the other side. What could break this thesis? What would force a strategic reassessment? A genuine resolution to geopolitical tensions that restores trust in the global system. A technological breakthrough that eliminates industrial silver demand. A surprise policy shift where central banks successfully achieve stable currencies without debasement. Discovery of massive new silver deposits that can be brought online quickly. Any of these would change the calculus, but assess the probability, honestly. How likely is a stable geopolitical environment given current trajectories? How realistic is replacing silver in solar panels and electronics within 5 years? How often have central banks in history chosen deflation over currency debasement when given the choice? When has a commodity supply deficit resolved quickly without significant price incentive? Risk assessment isn't about pretending these scenarios are impossible. It's about weighting probabilities and positioning accordingly. And right now, the probability distribution favors hard assets over paper promises. The historical pattern recognition matters here too. Bull markets in precious metals don't move in straight lines. They advance, pull back violently, shake out weak hands, then resume. Gold dropped 30% in 1974 before rallying another 500%. Silver corrected 50% in 2006 before quadrupling into 2011. These corrections feel like the end when you're in them, but in retrospect, they're just volatility within a larger structural trend. The investors who survive these cycles understand something critical. Position sizing protects you from being forced out during normal volatility. If a 40% drawdown in your metals allocation would cause you to panic sell, your position is too large. If you can weather a 50% correction without touching your holdings, you're positioned correctly. Because the returns don't come from avoiding volatility, they come from staying positioned through it. There's a moment in every major market cycle when the narrative shifts from if to how much. That transition doesn't happen at the bottom. It happens somewhere in the middle when enough evidence has accumulated that denying the trend becomes harder than accepting it. Precious metals are approaching that inflection point now. The question facing serious investors isn't whether this bull market is real, it's how to position for what comes next, and how to avoid the mistakes that typically destroy returns even when the thesis proves correct. Because getting the direction right means nothing if the execution fails. The scenario planning begins with understanding that markets don't move in predictable straight lines. They move through phases, each with different characteristics, each requiring different positioning. The base case, the most probable outcome given current conditions, assumes moderate continued instability. Central banks don't panic, but they don't restore credibility either. They continue managing through incremental policy adjustments that slowly erode currency purchasing power. Geopolitical tensions persist without major escalation. Trade fragmentation continues. Nations build alternative systems, but the dollar doesn't collapse. Industrial silver demand keeps growing. Supply stays constrained, but no acute shortage paralyzes manufacturing. Under this scenario, gold trends toward $3,200, $3,500 per ounce over the next 18 months. Silver tests $45 out $55, with violent corrections along the way. Quality mining equities appreciate 150, 300%, though individual company performance varies dramatically. This isn't exciting, but it's profitable for those positioned correctly and patient enough to hold through volatility. The bull case presents a different picture entirely. It assumes one of the simmering risks actually materializes. A currency crisis in a major economy, a supply disruption that cuts silver production by 20% or more, a geopolitical event that forces central banks to accelerate gold accumulation, or a policy mistake that triggers the debt crisis everyone has been postponing. Under these conditions, precious metals don't trend higher. They gap higher in moves that leave most investors behind. Gold could reach $5,000, silver could touch $100, and mining stocks could see the kind of explosive moves that defined the late 1970s. But here's what most people miss about bull case scenarios. They're not opportunities for those who wait for confirmation. By the time the crisis is obvious, the easy money has been made. The investors who benefit most from extreme moves are those positioned before the catalyst becomes apparent. That requires conviction, capital, and the psychological strength to hold positions that might look wrong for months before proving right. The bear case deserves equal consideration. What if central banks somehow achieve the impossible, stabilizing currencies without significant debasement? What if geopolitical tensions ease and trust in the global system restores? What if a technological breakthrough eliminates industrial silver demand? Under this scenario, precious metals correct significantly. Gold falls back toward $2,200, silver drops to $24.26, and mining stocks give back most of their recent gains. But assess the probability honestly. When in history have central banks with massive debt burdens chosen austerity over inflation? When have geopolitical fractures healed quickly once trust has been broken? When have industrial commodity demands disappeared overnight? The bear case isn't impossible, but it requires outcomes that contradict both historical precedent and current incentive structures. So what does intelligent positioning look like given these scenarios? The timeline matters more than most investors realize. In the next 3 to 6 months, technical factors and sentiment will dominate. Price could consolidate, retail enthusiasm could fade, and weak hands will sell into what feels like a failed breakout. This is where most people get shaken out, right before the next leg higher begins. The 6 to 18-month window is where fundamentals start overwhelming technical noise. Supply deficits become undeniable, central bank purchases accelerate, and the gap between paper prices and physical availability becomes a topic of mainstream discussion. This is when the move transitions from early to obvious, and when investors who waited for certainty finally enter, providing fuel for the next rally phase. The 2 to 5 year horizon is where the structural repricing completes. Either the thesis plays out fully and precious metals reach valuations that seem absurd from today's perspective, or something fundamental changes in the global system that invalidates the entire premise. For the business community watching this unfold, the implications extend beyond personal portfolio allocation. Corporate treasurers managing cash reserves need to assess whether holding dollars makes sense when the purchasing power erosion is accelerating. Companies with significant silver exposure in their supply chains need hedging strategies before industrial shortages drive input costs higher. Business owners considering succession planning or liquidity events should evaluate whether holding proceeds in traditional assets offers the protection they assume. The mining sector itself presents opportunities beyond simple metal exposure. Consolidation is accelerating. Majors are acquiring quality juniors at valuations that won't last. Royalty companies are expanding their portfolios while cost of capital remains favorable. And the knowledge gap between informed investors and the general market creates pricing inefficiencies that won't persist. The execution framework comes down to discipline. Phased entry prevents the psychological damage of buying at exactly the wrong moment. Rebalancing triggers ensure profits get taken when positions become oversized. And position sizing protects against the volatility that will absolutely occur. But the most important element isn't technical, it's psychological. The investors who capture generational moves aren't smarter. They're simply willing to hold positions that feel uncomfortable, to maintain conviction when the crowd doubts, and to ignore short-term price action in favor of long-term thesis. Because markets transfer wealth from the impatient to the patient, from those who need certainty to those who can tolerate ambiguity, from those who react to those who position. The perfect storm in precious metals isn't a prediction, it's already here. The only question left is whether you'll be positioned for what comes next, or explaining later why you weren't.